Well, why don't we go ahead and get started? Thanks for joining us. Jody Goss, I'm the president of the producers firm. I'm joined here this afternoon by two veterans of the annuity business. We look forward to hearing what they have to say. Their insights, probably combined, maybe represent, I know, at least hundreds of millions of dollars, maybe even billions of dollars of annuity business. So, as I said, experts in their fields, and I'll let them introduce themselves. So, why don't we start with you, Paul? Paul, can you tell us a little bit about yourself and a little bit about who you're with?
Yeah, hey, I'm Paul Garofoli, Regional Vice President with The Standard, 41 years of wholesaling experience. So pleased to do that, focused on annuities and focused on working with Jody and Bianca in this capacity. We have the good kind of annuities at The Standard, MIGAs, FIAs, all consumer-centric. We'll talk a little bit about that in the opening of my presentation. But now, Jody, back to you.
Thanks, Paul. And Bianca, can you share a little bit about yourself and
Absolutely.
Your background, your expertise?
Absolutely. So I'm Bianca Noizu. I've been with the producers firm for about 4 years, but I've been in the industry for over 25 years, actually. And I started working with annuities since day one. And I know we're going to talk today about Medicaid-friendly annuities. And I still remember the first one that I struggled through back in 1998. So we're hoping that we can, not to steal your thunder, Paul, but we're hoping we can bring the expertise to you advisors and help you out today.
That we will. And we've been in the same business as Bianca just articulated there for about 2 decades now, helping folks with Medicaid planning. We saw that as a great catalyst to help the types of agents that we work with gather gravitas, that's the word I'm looking for, gravitas with centers of influence, do a lot of great planning and helping for their customers. So we're super excited to talk about this topic and have an expert on board with us. But I'm just going to start our meeting with a share. The producers firm, we believe in bringing value to you, and we have a white paper that really drills down on this topic of long-term care planning outside of traditional long-term care insurance. So if you're interested in this tool, then go ahead. We're going to go ahead and launch our second poll here. And if I could find it, I lost my control panel. Oh, here we go. I'm going to go ahead and stop sharing and launch our next poll. So if you want this white paper, go ahead and let us know. We'll get that right out to you. You can launch that now, and then we'll send this out after the meeting today, this white paper that'll drill down on a multitude of ways that you can do long-term care planning and protection outside of traditional long-term care insurance. But one of the key components to that we're going to talk about today. And that's why we have Paul Garofoli with us from the Standard. They have an outstanding product for pre-planning and planning that you would do essentially at the last minute. Any estate planning attorneys that you work with may know about this, may be doing it, but you can bring your expertise to the field. And like I said, use this as a great catalyst to form relationships with COIs and bring a tremendous value to folks that you're working with. So Paul, why don't you go ahead and take it away?
Fantastic. What a great intro to today's discussion. We'll get it started here. So thank you, all. Garofoli. A lot proud to be working with Jody and Bianca on this capacity. Let's just go over a few things, a little warm up to today's presentation on Medicaid planning using annuities.
Hey, Paul, I'm sorry to interrupt. Just one housekeeping item. On the bottom of your screen, as we go along, if you have any questions, please lodge your questions there under the Q&A tab, and we'll take them as they come in, if at all possible. Sorry about that.
Fantastic. Okay, that's great. So let's just go get a little familiar with the Standard, and we'll get into the meat of the topic here. So a few things about the Standard that I think are interesting. We issue older age contracts all the way up to age 93 on 3 and 5 year contracts, 90 on 7 year, both MIGAs and FIAs. You can write on somebody already in a nursing home. You can use a power of attorney acting on behalf of an applicant from start to finish. So we have that ability to do those things. Our maturity age is 115. We provide a nursing home waiver on all our products at all times. We accept third-party ownership of our annuities. Trusts, corporations, pension plans, trusts in particular are very important in this regard. We accept joint owners and joint annuitant options. We pay a death benefit or full surrender value on death of the owner or the annuitant. Our products can be annuitized at any time, and this is a great pre-planning option to consider. We have a version of our MIGAs that is fully liquid at all times. And our anytime annuitization can be converted to a Medicaid compliant payout. So we're a great pre-planning outlet for your clients. And we also offer, as a rider, a substantial death benefit rider that is RMD friendly with few limits. So there's a full range of things that we do, but now to the heart of the topic, and that is planning for Medicaid using annuities when and where appropriate. Let's just kind of set the stage for why this is so critical. You know it intuitively. You're here on this. I wager that if you're on this call, anybody that's been in the annuity business, the financial services business, just living your life, you probably know somebody, might be a parent, might be a sibling, certainly a neighbor, somebody close to you that has had to use nursing home facilities and has had maybe to struggle on how to pay for it. So right now, 5% of the population is living and residing in nursing homes. And I'm talking about level 3 nursing homes, not just, not assisted living, not vacationing in Florida, but that's where they live. And, this statistic is always debatable because it always seems like it's higher depending upon your geography. But according to AARP, the median nursing home cost can run close to $100,000 per year. Some places in the Northeast higher, some places in the Southeast maybe a little bit lower, but certainly it's a substantial cost that any practitioner of financial services needs to consider. Without private insurance, Medicaid is the primary source of long-term care assistance. AARP states about a third of nursing home residents pay all of their nursing home costs from their own funds. That means 2/3 are getting help from some other place. So obviously it affects many senior Americans. They say that 7 out of 10 people age 65 or older may need some type of long-term assistance. That may not mean full-time residence in a nursing home, but they'll become ADL disabled, activities of daily living, unable to do certain things for a period of time, hopefully not for that long, but for some in a permanent type of deal. So how do you provide for care? Well, we know this. You deplete savings account. You can self-fund if you want. And if you got enough money, great. Get the blue chip care, happy day. You can try to mitigate that risk, transfer some of that risk or all that risk using long-term care insurance, or more and more, and available through Jody and Bianca, products, either both annuity or life insurance products that provide accelerated benefits that can help with either home health care or even full-time facility care. So the options for planning are as good as they've ever been. Even though providers of true long-term care insurance are diminishing, there's still some great outlets there. There are alternatives that can make a lot of sense. Well, rely on family and friends. It's a lot of times the oldest daughter that is kind of designated as the caregiver. It's expected in some cases that they're going to provide on that. Friends, sometimes that's a reality. But many Americans will end up on Medicaid. They'll need some type of assistance from the government for 3 reasons. They don't have the financial means to pay for the high expenses. They can't afford long-term care, or they're unwilling to pay for it because of that use it or lose it proposition. But really, ironically enough, it's one of the top of mind considerations for most people as they age. What happens if I get sick or hurt? So what is Medicaid? It's a jointly funded federal state insurance program for low income and needy people. It is a means tested benefit, but that definition of low income and needy can evolve. And so let's talk about that. It's based on federal law, but it's interpreted by the various states. It's truly a joint state federal enterprise. And so even though it's based on federal law, eligibility varies from state to state. And in some states, it can even be county by county. So there's a lot of rules and regulations. And I want to be clear, we are not looking to make you Medicaid planning experts. What we want to do is just make you aware that there are some resources available to you that when this becomes a client need, you're not, oh, what do I do? You'll have outlets, resources, and expertise to help in that. Remember, Medicaid is not Medicare. You know, a lot of times, sometimes we interchange it. Sometimes our clients don't understand that. In fact, most people don't understand it. I got Medicare, I'm covered. Well, Medicare actually doesn't cover traditional long-term care. Yes, there's some rehabilitative benefits. You might be in a facility, but that's really for a very limited period of time, mostly post-surgical, post-hospital, to recover, ideally, to get back home and get up and running. But some people that go in under Medicare are disappointed to discover that, hey, you're either going to get kicked out, or if you have to stay, you got to pay out of your own pocket. That is a sober event. Now, what about Medicaid eligibility, and how can we help people legally and ethically? And this is the key. This is allowed by various federal and state statutes, and we'll explain why in a little bit. There's an income limit. There's an asset limit. So there's two considerations in terms of qualifying. That varies by state. Also understand that those amounts differ for individuals versus couples. So in particular, a lot of Medicaid planning involves couples where the healthy spouse, otherwise known as the community spouse, can maintain a certain standard of living if assets are structured properly. And that's the key. States, in terms of eligibility, are either spend down or have an income limit. You have to spend down your asset base to a certain limit, minimum or maximum, in essence, to qualify, or you have an income limit. Medicaid planning can help meet either criteria. So these solutions that we propose or that are available to you can help regardless of the state. So keep those things in mind. As I mentioned earlier, most Medicaid planning is for couples. And one of the reasons is it's like, well, you know, why are we doing this? Why does actually there are statutes that really encourage some of this type of planning? And that is because the state and the federal government don't want to have two people that are destitute when they're trying to help one person. In other words, you can help the spouse that is going into the nursing home with proper planning, either pre-planning or what's called crisis planning. But you don't want both to be impoverished, and now the state and the federal government are supporting two people. So there is a certain way to structure assets, structure income, so that the healthy spouse, the community spouse, can maintain a level of dignity and a standard of living and not become a double burden upon the state. So the opportunity Medicaid law allows for the rearrangement of assets. So, you know, we're not working, you know, loopholes. It's in the laws to do this. Omnibus Reconciliation Act of 93 delegated treatment of annuities to the Secretary of Health and Human Services. Deficit Reduction Act. This is a little kind of technical background about that. So these strategies are well embodied in the statutes and the regulations that we have there. So what do you have to have? Because a regular annuity does not qualify. It's important to understand that annuities in and of themselves are like any other countable asset. and they have to be repositioned, restructured to help people qualify for assistance. But that's a key consideration. So they have to be actuarial sound. You have to have Medicaid or the state be the recipient, the primary beneficiary of any residual payments up to the point where care is met. So, again, we're not getting out of jail free, if you will, getting into the nursing home free. There's some structure to this that goes on. You have to obviously disclose that you have an annuity, the right type of annuity, and that right type of annuity, so-called Medicaid friendly, the term, we call it a restricted. And what is restricted is the language associated with the payout. That payout is irrevocable, non-assignable, actuarially sound, must be paid in equal amounts, typically over a life expectancy payout. Even though it's a period certain life expectancy payout. So ultimately, what is a Medicaid compliant annuity?
Hey, Paul.
In general,
we just have one question here. I'd just like to answer real quick, if that's all right.
Sure.
So the question was, what are the limits? And they vary, as you said, Paul, from state to state. For those of you who are familiar with our customerrounding.com website, customerrounding.com, it's password protected. If you don't have the password, please reach out to us. Under the resource tab, there's a resource there that will walk you through what those limits are. So customerrounding.com, if you need the password, reach out to us and we'll provide that for you.
Yeah. And then I can speak in general. Remember, these vary state by state. Generally, the income limits are in the 2000s, $2,300 to $2,700, depending upon the state, the income limit. The asset limit for the community spouse can be in the $125,000 to the $145,000 range. And then there's other assets that the community spouse can keep, such as their house, a car, things like that. There's also some trust mechanisms that can help protect assets to a certain extent. So even though people that have substantial asset base, they still might benefit from this type of planning. But in general, relative to Medicaid, assets are bad. Income up to a certain limit is good. And that's a very general statement, but you can't have $1 million in assets and qualify for Medicaid. You might say that's kind of silly. Jody, Bianca, we have people call us and ask us about that. But there are certain ways to restructure those things. Payments up to a certain limit that are structured in this way will not count against Medicaid eligibility. So ultimately, what we're working towards is meaning a spend down of assets. When that is met by way of this type of annuity, converting an asset to a stream of payments, many times to the healthy spouse, so that they can maintain a standard of living. The applicant, the sick spouse, the person that is seeking assistance, may qualify for benefits.
Hey, Paul.
So essentially, go ahead.
I'm sorry, if I could just put something in here. So essentially what you're saying, if I got it right, you're converting an asset into a protected income. Is that in a nutshell?
That is it in a nutshell. Jody, once again, you have proved your mastery of the subject, boiling the complex to the simple.
So an asset that would be disqualifying is converted to an income that is now qualifying. The one thing I would just offer, this actually is a fantastic opportunity to get introduced to a COI. Our experience, and we do, hundreds of thousands of dollars of this, sometimes every week, but definitely every month, is don't go this alone. Don't try to figure out how much can my client spend down? How much can I convert to the annuity? Take advantage of this opportunity to go and work with their attorney and get the attorney to do the calculations and you deliver a product. Attorneys are looking for individuals that can deliver this product. They aren't looking necessarily for individuals that'll do the calculations because that's what they do. But this is a fantastic opportunity to now make yourself available to a COI and deliver a product and solution to your client and now their client.
Great summary, and we'll provide that as kind of the action steps at the end of the discussion. So The special kind, a regular SPIA, single premium immediate annuity, does not count. You have to have the specialty language, which the standard has: non-assignable, non-revocable, non-surrenderable, non-transferable, non-redeemable, non-commutable. We have all the restrictive language. What the Medicaid folks don't want to have happen is somebody buys an annuity and goes, okay, great, I'm only making $2,000 a month. And then once they qualify, they, in essence, cash out that annuity. They sell it to J.D. Wentworth. You cannot cash out this annuity. It is a stream of payments for a specific period of time, thus not, or converting an asset to a restricted stream of income that can be qualifying for Medicaid. Let's take all this and give a practical case study. Remember, there is individual Medicaid planning, but a lot of Medicaid planning is for couples preserving assets for the healthy spouse while legally and ethically qualifying the ill spouse for some degree of assistance. So we have Jennifer and Greg here. They're a married couple. They've got some serious assets here. It's not too bad, $426,000. And I just want to preface this. I'm just giving an example. So you go, wait a minute, I thought the asset limit is 147. We're just trying to give an example here. So don't get caught up in the numbers, but just think of the process and the outcome when we do this. So Jennifer, in this case, is the one that needs the nursing home, $6,000 a month. For those of my friends in the Northeast, you might go, man, that's a bargain. There's no way near that's what it costs here. It's $10,000 or more up in New England. So ultimately, do the math. It's going to deplete. They could pay out of pocket. Okay. And then what? All right. Well, generally, then you go on Medicaid because you ran out of money. But what happens to Greg? Well, how does he live? How does that go on? So a Medicaid compliant annuity can help with that spend down that normally they would have to commit to funding the nursing home care themselves. But by protecting it and converting it into an income stream that's non-assignable, or irrevocable, non-commutable, non-transferable, non-redeemable, non-commutable, that might help care. So what is the math here? And again, don't get caught up on the math, but we assign the assets, and really the elder care attorney, the senior planning specialist is doing these calculations based on the requirements of the respective state that you're providing service in. But each spouse's share of that asset, it's split 50-50, in this case, $213,000. Greg keeps $100,000. Right now, the limits are a little bit higher, might be $125,000 in some states, as high as $147,000 in others. So he can keep $100,000 off the top and protect that. So you have that, and as it says, it varies state by state. Now with the balance, that is now a countable asset that they would have to spend down. He combines that with Jennifer's part of the assets, fairly substantial number, but once they commit to a Medicaid compliant restricted single premium immediate annuity, as we call it at the standard, that asset is no longer countable because it's not an asset anymore. It's income. And it's based on Greg's life expectancy. He's 80. There's tables that are typically used, usually the Social Security mortality table. At 80, he probably has 15 years of life expectancy. The payout is not a life-only payout. The payout is a period certain based on the life expectancy. So in Greg's case, let's say the life expectancy for an 80-year-old person was 15 years and 3 months. The SPIA would pay every month for 15 years and 3 months, converting and protecting that income or that asset into income so he can maintain a standard of living.
Hey, Paul, I have a question. Can it be less than life expectancy?
No. In order to be compliant, it's got to be life expectancy. Now, sometimes You'll see very short durations. In some states, you might be talking about like shorter payout durations. I'm talking about the typical case here.
Okay.
Sometimes it can be less if the elder care attorney determines that the spend down period does not have to be life expectancy. In some cases, that is the case, and that's probably what you're recalling.
Okay.
But for this purpose, yes.
But it
Most
can't
of
be
the
longer
time-
than life expectancy. Like,
Right.
Yep.
Correct. You have there. And oh, by the way, in the payout, the primary beneficiary is the state Medicaid provider. The contingent beneficiary, and this is why it's good for estate planning, can be the couple's children, grandchildren, whatever they want. So, if you kind of go, oh man, look at this, we're gaming the system, you aren't. Because if something happens to Greg, then the remaining payments up to the level of care for his wife will be paid to the state. And then if the wife, let's say he or she passes on early, he passes on, the care is reimbursed to the state. Whatever remains, those payments go to beneficiaries. So there's still some advantage here. Application setup, Jody and Bianca and his team will help you take care of this. Healthy spouse, the annuitant is the healthy spouse, the payee is the healthy spouse in this case study. Primary beneficiary, as I said, is the state Medicaid program up to the amount they have spent for care. The beneficiary designation would be state of Texas, state of Connecticut, up to the amount of the cost of care provided. The contingent beneficiary.
I'm just going to pop in right here too, because each state has a specific wording for how they want that to be expressed. So you say up to the amount of care, each state has strict requirements on how it's actually supposed to be written into the application. So something to be mindful of when you're working with the attorneys in that state.
Right. And ultimately, what we're trying to impart upon you is we do these. We provide the product and we provide resources, which I'm going to share with you. But this is not DIY. This is not the home and garden channel for Medicaid planning, okay? This is not Chip and Joanna Gaines, or maybe you need a Chip and Joanna Gaines that are elder care attorneys. You should be networking and working with an elder care attorney. Now, sometimes you may be the person initiating the discussion, great, or sometimes your clients have had the discussion and now they know that they need something and now they come back to you. Do you have this? Can you provide this? And the answer is, by your affiliation with Jody and Bianca, you can. So we have that. Let's give you some basic guide for advisors here. Look for situations where the husband and wife can expect one or sometimes more, but usually one to enter long-term care facility here. We know 7 out of 10 are going to need some level of care. A lot of times when you're doing your annual reviews, where you're prospecting, you kind of go, wait a minute, somebody's on oxygen and the other person looks to be the primary caregiver, and we kind of see where this is going. So just be aware of those situations as you monitor your client. Always instruct your clients to work with an elder care attorney. That goes without saying, or it goes with saying. Obtain a proper annuity illustration and disclosures. Basic blocking and tackling here. The annuity in question, a regular SPIA will not help. It will be countable. It will be recoverable. It'll be capturable. It has to have that restricted endorsement so that the state knows that you can't convert this back into a lump sum and then truly game the system. Non-transferable, non-forfeitable, non-assignable, non-communable, irrevocable. That's the language that we have in our restricted payout. No change of payee, no change of payment option, no cash value. Those are the criteria that allows you to convert a countable asset to an excludable stream of income you have. Some additional considerations. And Jody, this goes to some of your point here in terms of the pre-planning element. And this is what I think is fascinating. If we know from our own personal experience, from all the statistics, that out of 2 people, somebody's going to need care at some point in time. Hopefully it's a short term, hopefully it's recoverable, but we know this in our families even. that we've had this experience. Why consider the standard overall in advance of a crisis event happening? And that is on our very competitive MIGAs, on our very competitive FIAs. We have an anytime annuitization clause built into the contract. They can be annuitized at any time. And that annuitization can be regular, just regular payout, or it can be restricted, since we offer restricted SPIAs in and of themselves. Now, the beauty is it's a great pre-planning option. And maybe you've had this experience and maybe you haven't. I've had it as a wholesaler, where an agent calls desperate. Paul, you know that annuity I sold last year? I need to cash it out. Well, wait a minute, Jody. There's going to be surrender penalties, and I might have to charge back your commission. No, Paul, we got to cash it out. The client's daughter is in a panic because they fell and broke their hip. They had a stroke. They had some major medical event. Now they got to go into the nursing home. And now that regular annuity is a countable asset. And the elder care attorney told them, cash out everything. And we got to do that. Now, guess what that elder care attorney does once everything is cashed out? Jody, you tell me, what does he do once all that is cashed out?
He asks us to redeploy it into a restricted Medicaid planning annuity, which is obviously not the greatest plan.
Right. And so, the beauty is, and this gives you a sense of how valuable the planning is, that even an officer of the court, an attorney, will encourage the client, cash them out, take the surrender penalty, because the value of this planning and converting that annuity into cash and then into a restricted SPIA. What's the point? It's already built in. Hey, why are you recommending the standard? Well, in addition to the great rating, the great products, the great rate, the great indexing, they have a clause, unlike just about any other carrier out there. I don't know of anybody. There may be one or two
other carrier.
All right, you don't know anybody. Let's assume maybe there's one other carrier that does this, but of a primary carrier, we're the only one that does it. I'm recommending the standard in case you need to do planning for long-term care, their products convertible in a way that might help you or your spouse qualify for Medicaid or long-term care assistance from the state. I'm knocking on wood, hope it doesn't happen, but you have that. And by the way, that conversion is at full contract value. It does not incur a surrender penalty. But always, we come back to it. All right. Always instruct clients to work with an elder care attorney. But what a great pre-planning option. No drama. I love to eliminate drama in your lives.
Hey, Paul, can I just
go ahead? You can do, Jody, it's your webinar. You can speak at any point in time.
I just want to reiterate what you just said. It is a phenomenal pre-planning option. We all understand the crisis planning, right? Mom, dad is in the nursing home. Husband, wife is in the nursing home. You're in crisis mode. You're in spend down mode, and you got a flood of decisions coming your way. But if you could incorporate all the benefits that annuity provides, and if you're not intimately familiar with those, please reach out to Bianca. She is an annuity expert. She will help you understand the nuances of an annuities. And I'm going to give this one other plug to the standard. This isn't a FIA workshop, but they have multiple strategies that are guaranteed participation rates for the life of the contract, which is huge. Tremendously consumer-friendly product. But all the benefits of an annuity and a tool that gives peace of mind on probably the second greatest fear that a retiree has. The number one fear is outliving their money. Number two is losing it to the nursing home. And you can do all of that planning in one vehicle. So I agree with you. This is a phenomenal feature, Paul.
Awesome. And then to back it up, we have resources. A lot of carriers they kind of go, hey, come into this back alley here. Yeah, we do Medicaid friendly SPIAs, but don't tell anybody about it. We don't, It's like they're not proud of it. It's like, hey, this is legitimate planning. And if we can help people in this age category, we're proud to do it. In fact, we have resources we have a toolkit that can help you open up the conversation with your COI, Center of Influence, and your clients as well. You have a restricted SPIA toolkit. What do you have? I mean, not a whole bunch of stuff, but, product outline, flyers that talks about this, the case study with Jennifer and Greg, something similar to that, how it works, articles. So to give you a sense of confidence, but to also make your clients familiar with this part of planning. Now, here's some practice pointers.
Hey, real quick, we did have a question come in, and the question is are the payouts competitive? In other words, are you putting it to the customer because they're converting your annuity to an immediate annuity?
All right. So the short answer is yes, but you have to, you almost have to reverse your thinking. Okay. Because remember, it's the structure of the product. It's not a payout. You don't spreadsheet a Medicaid friendly annuity in terms of the payout. Why? Because actually you want a competitive payout, and it's got to be, actuarial sound. Ours is actuarially sound, but like the highest payout, if you had the greatest payout of all time, you might make your client ineligible. The payout, and don't get me wrong, it's important, but the payout for the questioner, it's besides the point. It's besides the point. It's the duration of the payment, and it is the structure of the contract that is most important. So understand that. But if you compare us with the handful of carriers that do restricted SPIAs, we compete in terms of the payment.
I can tell you based on our.
And remember, the client either the client or the state or their beneficiaries get all of their money back plus an interest rate factor there. That's the life expectancy period certain element of it. But it's always interesting. Is your payout competitive? Ultimately, I go, who cares? It's the planning. It's the ability to deliver the product that is most important. And that's why Jody and Bianca recommend the standard to that regard.
Well,
now, practice pointers.
On the pre-planning side, your current annuity rates, very competitive. Number one. Number two, to your point, Paul, in any given state, there is less, let me reiterate that, there is less than a handful of annuities that deliver this option. So the pool of competition is minimal. And our experience is the standard ranks at, right at the top as far as payouts. But the reality is there's very, very little divergence.
Right.
At the top in the entire heap. So
really here's the questions you should ask. How quick can you turn these things around? Because when we're doing, in particular, crisis planning, right, Jody, right, Bianca? It's like, hey, we got to get this done in 7 days, 5 days, because a lot of times there's a time limit on asset conversion, on when the person can qualify. And we are very attentive when you put, hey, this has to be in place so that my client can apply on such and such a date. That's what we see. So that's the question. No offense to the questioner. That's really the question. And I'll answer the question. We're really good at that. So we pay particular attention to these issue demands, typically from the elder care attorney. Hey, this has got to be issued by October 23rd. Period. Okay, then we're going to issue it by October 23rd or earlier. Real critical. We're really good at that. Now,
and I'm going to just jump in and vouch for that. A lot of times these annuity cases are almost a hurry up and wait. You'll start working with a client. They have this need. Then you're talking with the estate planning attorney. They're meeting with the client, and they're getting, everything's getting put together. And then all of a sudden it's issue it. And it's within a couple of days. And you have to jump. And so to work with a company that has a process in place to turn these over quickly is very, very important. All of the cases that I've seen, it's let's act on it, but it's a lot of hurry up and wait.
but so critical that you pick a partner that can meet these deadlines. So what are the recommendations that we make here? Engage your clients and prospects in the what if discussion. Hey, what if something happens to Susan? What if something happens to you? What's your plan? How are you positioned? Who are you going to do this? There's a joke that when these discussions happen, and I don't mean to make light of it, but well, I'm gonna take a gun and shoot myself.
Mhm.
That's my plan. And of course, the answer is, by the time you get to that state, you'll likely forget where you put your gun.
Right.
So that is not a solution.
Right.
There's not a solution. It's like, hey, and that's where sometimes you earn your commissions in terms of, hey, listen, that's not a solution.
Mhm.
You know that. Do you want to put this burden on your wife, your husband, your elder daughter, and no offense or the daughter that lives closer? Why do I say this, Paul? We live in a multi-diverse world. Guess what? That's where most of the care is coming from, is from that older daughter. And I can speak to that because my wife helped care for her mom and her sister. So I've lived that experience all too well, and you probably had that. So another key consideration.
We did have a question come in. If it's all right. What asset range do we typically see this apply to? This is generally a middle America type of planning tool, but we do see annuities the size. I think the largest one I've been involved in personally was 800,000. And I think that's another really good point, Paul, is typically, we see suitability block anything over half of the annuity, the total asset value. This is completely different planning. The standard understands that. Those traditional suitability rules, you all understand, they're doing it for a purpose. So, if they're only protecting 145,000 after we do the SPIA and we put 800 grand into an annuity, are they going to get a roadblock by the standard in doing that?
No, there's actually a special suitability form that allows us to recognize this. Because remember, in terms of what you're trying to do is you're trying to make a person legitimately and technically needy. Mm-hmm. And so, it's like, oh, we can't tie up all the money in the annuity. Yes, you can, if it helps for the greater purpose of qualifying for benefits. So yes, we understand that whole process, and you don't have that typical pushback on percentage of annuity ownership. You might have to have 100% of assets into the annuity in order to help people to qualify. In terms of practice pointers here, introduce yourself to the next generation. Those are the beneficiaries on the products and accounts that you have, because ultimately, hey, I'm working with your mom and dad, Timmy Jr., and I do want to engage you in a discussion, talk to them about certain things, about planning things. They're near and dear to me. I want to just kind of engage you in a discussion about if something happens to one or both of them, what's the thought process? And they may go, no, I've already built a house and I'm training to be a certified nurse. Hey, great. They're still going to need money. Hey, would you like to protect some assets to help fund that? It might open up a whole nother discussion, even if you never get into this Medicaid compliant restricted payout. But engage those people, because they're going to be all in whether they want to or not if mom and dad get sick or hurt. Network. This is a great opportunity. Network with local elder care attorneys that you can be a resource, because this is a two-way street, in that at some point in time, you're going to have clients. If you are in the annuity business, the retirement income, the asset protection, asset preservation, wealth transfer, whatever you fancy yourself as, you're going to have somebody that's going to be in this situation. So you will be a pool of prospects for the elder care attorney. And then ideally they'll go, you know what? That Jody's a good guy. I've got these other clients. Let me give him a call, or give Jody a call, and he can help you with filling this order. In a perfect world, and no offense, in a perfect world, you want to become an order taker. No, Paul, I'm a financial professional and no. with this, you want to be an order taker. You want to have the relationship with an elder care attorney or equivalent certified Medicaid planning specialist that they go, hey, I need for an 82-year-old, 322,000, life expectancy of 13 years, 4 months. Give me the quote. Great. Okay. Give me the app. Can you go write it up? Fantastic. That's the ideal situation that you get into. So by networking with people, having that cup of coffee, hey, I just thought, dropping a note, those kinds of things, just so you know, I have this resource available from an A-rated, multi-billion-dollar company that's had decades of experience in providing this type of product. And then the other part of it is network with providers, facilities, independent living, assisted living, and home health care agencies in your area, because they're the people dealing with folks. And it's like, hey, they need some planning, and you can be that resource to them to help with that planning. And again, in an ideal situation, you just may help them self-fund or self-insure with the great products. Jody has access to annuities with long-term care benefits in and of themselves. He has access to life products with accelerated benefits that might help, single premium life. So there's all kinds of ways to address this need by simply identifying yourself as a resource that can provide this type of care. Jody, I opened it up for questions, but man, we had the questions coming fast and furious. Are there any more questions that we might answer?
There's none posted right now, but if anyone does, by all means, post them. Just to your point, Paul, I'm going to share this. Our top agent in this arena is just that, an order taker, and he takes between 3 and 5 orders a week. So the point being is there is a lot of opportunity here, and it does create a fantastic way to show your area of expertise in a COI world, and start to forge those relationships. So it doesn't look like we have any other questions here, but I'm just going to close this out. Thank you so much, Paul. The producers firm is fully committed to helping those that work with us not only learn how to utilize this tool, but strategies for Social Security planning, retirement planning, on-site workplace planning. The list goes on and on. So if you're interested in learning more about what we've talked about today, I'm going to launch our final poll here, and just let us know. We will go ahead and launch this now and get off to you information. We can also get out to the slides for today's presentation. We recorded it as well, so if you want the recording, just let us know. It looks like you did a great job, Paul. Bianca, we don't have any final questions here. Thank you so much for the time that you spent with us today. I know I did find it very, very insightful and invaluable. We really appreciate that.
Appreciate you, Jody. Appreciate you, Bianca. And thanks everybody for taking the time to share with us today and make this a part of your practice beginning right now.
Thank you, Paul.
Bye, everybody.
Bye, everyone.